Let's kick this off. Welcome to The Explainer. If you're a new investor diving into the digital asset space right now, you're probably hearing totally conflicting narratives about Ethereum. Is it just some magical internet coin? Is it completely dead? Well, today we are literally throwing those outdated ideas out the window. We're going to demystify this incredibly complex landscape and look at Ethereum for what it truly is today, a mature, dividend-yielding tech equity.
$34 billion. That is a massive number. And it's the size of the tokenized asset market currently built on traditional finance rails, largely using blockchain technology. And guess what? Ethereum is at the absolute center of all of it. But here is the huge paradox we really need to unpack for you today. With this unprecedented level of institutional success, why in the world is the price of Ethereum stubbornly stuck between $2,100 and $2,400?
Okay, let's dive into this. Here is our clear 5-step roadmap for today. 1. The valuation paradox. 2. The institutional bull case. 3. The new tokenomics trap. 4. Competitors and bearish threats. And finally, 5. We'll synthesize everything into a clear investment verdict. Let's jump into section 1. The valuation paradox. Technological triumph versus suppressed price. We're looking at a totally fascinating divergence right now. On one hand, Ethereum has achieved historic milestones of technological dominance. The network absolutely dominates decentralized finance, and they've executed these flawless network upgrades. It's fundamentally stronger and more heavily used than ever before. But then you look at the market reality, and the price is just suppressed. It's really struggling to reclaim its all-time highs from 2021 and 2025. Basically, Ethereum has become a victim of its own technological success. Its direct financial value capture has actually been dampened by the exact same upgrades that fueled its massive growth. Moving right along to section 2, the institutional bull case, and how Ethereum is building an impenetrable traditional finance moat. Now, if you're new to this space, there's a crucial acronym you absolutely need to know: RWAs, or real-world assets. This simply means taking traditional financial assets, think US Treasuries, money market funds, or real estate, and representing them as digital tokens on a blockchain. We are seeing traditional finance giants moving actual, heavily regulated assets straight onto the blockchain. And this really illustrates why Ethereum is totally crushing this race. Out of a $34.1 billion RWA market, Ethereum single-handedly captures over 55% of the pie. It is the undisputed, legally recognized settlement rail for traditional finance. Let's look a little closer at what that dominance actually looks like in practice. BlackRock, literally the largest asset manager on the planet, built its BU IDL fund directly on Ethereum. And that fund amassed $2.9 billion in assets by early 2026. You got JP Morgan and Fidelity deploying tokenized funds here too. These tokenized treasuries offer pristine collateral yielding around 4%. And that right there is Ethereum's institutional moat. Asset managers are treating the network like highly durable, dividend-yielding tech infrastructure. It's a total game changer.
All right, section 3, the new tokenomics trap, the irony of efficiency.
Over the last couple of years, Ethereum has rolled out a series of just flawless technological upgrades. Back in May 2025, we had Pectra, which drastically improved user experience. Then in December 2025, the Fusaka upgrade exponentially expanded data capacity. And now in 2026, we have Glamsterdam optimizing efficiency. These upgrades were brilliant feats of engineering. They made Ethereum's Layer 2 networks, which are basically digital fast lanes built right on top of the main chain, incredibly fast and drastically lowered fees for everyday users.
But oh man, here is the massive catch. By making the network so incredibly efficient and dropping transaction fees through the floor, Ethereum accidentally killed its own most powerful price narrative. Think about it like a toll road. It built a superhighway so efficient, it literally stopped collecting enough tolls. Back in 2023, Ethereum was known as ultrasound money. High fees meant a lot of ETH was burned. It was a deflationary asset. It burned 125,000 more ETH than it issued. But jump to the reality in 2025. Because fees are now near zero on those Layer 2s, the burn rate just plummeted. Ethereum ended up adding 563,000 tokens to its supply. It reverted back to inflation.
And you know, this tokenomics trap has a really direct impact on yields. Right now, a US 10-year Treasury yield gives you a relatively risk-free 4.2%. Meanwhile, an Ethereum staking yield is sitting around 2.3% to 3.0%.
So if you're managing conservative institutional capital, taking on the technical risks of smart contracts, the regulatory uncertainty, and the wild market volatility, all for a lower yield than a standard treasury bond, yeah, that's deeply unappealing.
Let's pivot to Section 4, Competitors and Bearish Threats, the Layer 1 Landscape.
To really grasp the competitive landscape as a new investor, you have to zoom out and look across the broader digital asset ecosystem. Look, Ethereum is the absolute king of institutional settlement. It has huge total value locked, meaning tons of user deposits. But its high base layer costs mean everyday retail users essentially get priced out when the network is congested. Contrast that with Solana. Solana monetizes raw volume. It has ultra-low fees and totally dominates high-frequency retail trading. It's essentially the retail casino of the space. And then you have Tron, which is dominating emerging market capital flows. The main takeaway here is that the digital asset market is not a monolith, and Ethereum is unequivocally losing the everyday retail user to faster, cheaper, monolithic chains.
There's another massive threat to Ethereum's price we need to talk about, and analysts call it the AI premium misalignment. We all know artificial intelligence is the biggest, hottest narrative in tech right now. And yes, autonomous AI agents are absolutely using Ethereum smart contracts to execute complex financial transactions. But, and this is a huge but, the capital flowing into the AI narrative is not buying Ethereum. Investors are chasing specialized AI infrastructure tokens like BitTensor's TAL or Render's RNDR. The AI agents use Ethereum's rails, for sure, but the actual financial value is being captured somewhere else entirely.
Finally, we can't ignore these sobering regulatory headwinds. Governments are definitely legitimizing blockchain, but they are also trying to extract value from it. The EU has its MiCA compliance wall hitting incredibly hard in July 2026, which is creating massive operational friction for startups. And then look at local tax directives. In Italy, for instance, we're seeing a punishing 33% capital gains tax on crypto assets, plus a 0.2% wealth tax just for holding your own assets in self-custody. These aggressive rules create severe friction for everyday investors.
Which brings us to Section 5, the final investment verdict. Based on everything we've covered, here is how the potential price trajectories break down. Our bearish target sits between $1,700 and $2,200. Now, this happens if the network's inflation simply overwhelms the buying pressure. Our base case sees a recovery to the mid-3000s, assuming Ethereum maintains its massive institutional monopoly. But to actually hit that bullish target of $3,900 to $4,200, one of two things needs to happen. Ethereum requires either massive Layer 2 volume growth to start burning more supply again, or we need the Federal Reserve to aggressively lower traditional interest rates to make Ethereum staking yields attractive once more. So, to summarize this investment case for you, Ethereum is no longer just a purely speculative coin. It is an irreplaceable global settlement layer. It operates fundamentally like a dividend-yielding tech stock. It's blue-chip infrastructure, plain and simple. But if it wants to see massive price appreciation, it absolutely must figure out how to capture financial value from its wildly successful but hyper-efficient Layer 2 networks. Put simply, it has to solve its own monetization problem. Which leaves us with this final, really profound question to consider. Will Ethereum solve this monetization problem and unlock its next major price run? Or will it remain a beautifully engineered piece of infrastructure permanently constrained by its own technological efficiency? Keep a really close eye on those Layer 2 transaction volumes and institutional RWA integrations in the coming months. Thank you so much for joining me for this explainer, and as always, keep learning.